Hello, hello. It's your boy. I'm your boss, Joe Boss, and welcome to another week ahead trade plans video. Starting the stream a bit late today, but still doing the stream. I had to take care of a couple of errands here around lunchtime on kind of last minute notice, so starting the stream about an hour or two late. Forgive me. But with all that said and done, you know what? I'm starting to find the trading economics section here, the news section on trading economics, to be incredibly insightful. I mean, comboing this with financial juice and mainstay for me. I really like the news section on trading economics and following up with real-time news in financial juice. This is a really good information combo to really quickly figure out what's going on. And as I was browsing trading economics, I found out that they have a whole week ahead section. And I've seen this before, but man, is this detailed or what? And it's also quite brief. It's 3 paragraphs compared to sometimes the pages and pages and pages of stuff I get sent through institutional outlooks. And for everyone who's in the trading group who has access to these indicators, or even in the trial, you'll be able to join me on Saturday, tomorrow, at 2 p.m. Pacific, 5 p.m. Eastern, for the Outlook review event where we go through some of these outlooks and help try to set better expectations for the week ahead. So I'm going to go ahead and do my best here on a lot of these assets, set the what I call the nominal expectation. So if you're not familiar with what I do on these week ahead trade plan streams, I use my indicators, the probability pivot points and the range probabilities. And I try to find the areas with the highest odds of finding your high or your low or your close for the week ahead. You can kind of see sometimes I hit the mark, like this week, on a lot of the FX pairs. And sometimes I totally whiff it. Sometimes I'm partially right. Sometimes I'm partially wrong. I mean, I would honestly argue that this week was not totally perfect in all seriousness, right? I had the overshoot right here on my expectation. You can see all the lines here are time stamped. But I hit the rotation, the timings, so where these pivots occur, I hit that. And within a margin of error, I think I did a pretty good job of setting the overall net expectation going into this week. But one thing I wasn't expecting was to have such a strong manufacturing PMI out of the United States and to have such a strong NFP. Those two things are, none of it's mentioned here. Let me real quick go to my notes here because I actually have started taking notes for some of these streams because I find when I take notes to keep me on topic, it helps a lot. So I got notes here on. Oh, I'll be right back. There we go. Everything's back now. Yeah, I wish I could disable that feature. Whenever you're holding a window and you're moving it around on Windows, for some reason it automatically hides every other window, and I find it so annoying, when I have, 5 or 6 windows open, it just closes everything automatically. Anyways, let's go ahead and read this. This week, the United States will capture investors' attention with its inflation rate and FOMC minutes. So next week is CPI. CPI, as far as I know, I'm gonna say it's gonna come in hotter than expected. Reason being, if you've been following any reputable guys who are on the financial space here on YouTube, everyone is essentially talking about the risks to higher inflation. And this is mostly from the services side of inflation, where housing isn't falling fast enough, housing rents and housing prices, home sales and inventory are at still very constrained levels. So, and there's still a lot of demand. So you're seeing pricing for housing staying essentially flat, if not even rising in some places. At least in the United States, because we have U.S. inflation coming up, so we're going to focus on the U.S. economy and how the U.S. economy can give us some insight into what the Fed's policy going to be in the future. But the other thing I want to mention that is of greater concern, and that I think we're going to see a lot more institutions, a lot more pundits on Bloomberg and Reuters articles and whatnot talk about, is not just the contribution of energy. I mean, just look at this for oil. It's now way up here. This is nuts. And then gas, if I can remember, it's RV. Yeah, gasoline, not natural gas. The price of gasoline has just gone through the roof here. It is not great for anyone who owns a car right now in the United States. The price of gas in some areas has fallen a couple of cents, but that's after it's risen super significantly. And throughout the entirety of March, it's been on a rip roar and a tear. So when you look at oil as a manufacturing input, oh, I should probably mention this. So why does the increase in energy prices actually matter here for inflation? I mean, don't get me wrong, these are components of inflation and they're going up, so yeah, it's likely to go up. But there's a bigger risk that I said I wanted to point out that I think we're going to see more people talk about. And that's from the manufacturing. Let me see if I can find that little article here. Yeah, this is the problem. So in the Outlook review session, I'm going to be going over this article here. This is Chris Williamson who. No, thank you very much. I don't want to talk with you guys right now. So this is an article from S&P Global. So these are the guys who actually create the at least S&P IHS market PMIs. The ISM is different from S&P PMIs, so just know the S&P global PMIs are the more accurate, are the better metrics, the ones that I prefer going to than the ISM numbers. The ISM numbers are really not as accurate. They don't have as high of a correlation to GDP or inflation as the S&P numbers here. So I prefer looking at the PMIs here from S&P Global. And this guy, Chris Williamson, real quick, just so you know who he is, this guy, this beautiful man, chief business economist for S&P Global Market Intelligence. He was the head of IHS Markit before they got acquired for S&P Global. This guy is essentially in charge of running the PMI surveys. He since 2008, since the Great Financial Crisis, he's been in charge essentially of running the PMIs and also developing a world-leading provider of business surveys. Yeah, and yeah, that's where he went to school. Similar experts. Da da da. So whenever I see stuff by Chris Williamson, I try my best to put some time aside to read what he has to say. Because this guy, I'm the boss, but this guy's the boss of the PMIs. So let's go ahead. Uh, I mean, we can read this little blurb here, and it'll essentially tell us what we need to know. But there's a couple of charts here that I want us to take a look at. Global prices rise at fastest rate in 10 months. So when we look at this chart here, actually, if I just copy and paste it over here, oh wow, uh, that is transparent, so I can't really copy paste it with the white background. Maybe if I do this, yeah, that should be much easier for you guys to see. It doesn't seem like. Yeah, 1 second. I got to do a little bit of adjustment here. There we go. That should be much easier for you guys to see now. So this is what we're looking at: global consumer price inflation and PMI selling prices. So the selling prices is a component of the PMI surveys. Now there's a selling prices component in the manufacturing and the services PMIs. So what we want to look at is, I mean, again, this is global, but on the US front, things are, let's see here. Yeah, here's the US side of things. PMI prices changed for goods and services. So this is composite. This is the US here in blue. And I don't know if you can see that here on the far right, but this thing has now hit a new high that we haven't seen essentially since the first quarter of 2023 here. So prices for goods and services. So this is composite. When they say goods and services, they mean putting them both together, and that creates your composite PMIs. So the composite PMI in, let's say, the UK, for example, has essentially been flat. The US has seen sharp rises. Now, this sharp rise in selling prices actually comes from the goods component of these PMIs. So you can see composite PMIs, prices changed. You can see the US from March to February, you've had this huge bump higher. Manufacturing PMI prices changed, and this is the big concern here at the very, very top. The manufacturing PMI prices changed. The reason why the manufacturing PMIs jumped so much is because the prices changed components have jumped significantly. This was the major subindex that created the jump in the manufacturing PMIs. So why is this important? It means that manufacturers are passing on the inflation that they're experiencing from all the inputs they're taking in from, their energy and from sales and inflation, and they're passing it on to their consumers. This is really not good because the services side of inflation is sticky right now. That's why we've had sticky CPI, but now we're seeing this reacceleration in goods inflation. And the deceleration in goods inflation was one of the reasons why headline CPI had been falling and falling and falling and having a slight negative drift to it over the last several months here. So this really isn't good for our future expectations going into the summer. This could be particularly bad for the Fed's future path of rate hikes. Because if inflation begins to reaccelerate, and with NFP that just came out, employment is still booming and unemployment is essentially staying flat, guess what? You're going to have a real possibility of maybe you only get one cut in September from the Fed, or one cut in, two cuts from the Fed this year, or one cut from the Fed this year, or no cuts. That starts to really be on the table. We're really at this point not going to have enough data to come to the decision, but the pricing for Fed cuts already, the majority move just got shifted over to September as the first likely time we'll get a rate cut, which means they'll probably cut in September. and maybe they'll cut in December. That's the current pricing. But if inflation continues to stay stubbornly high throughout the summer, so going into July, as the Fed funds rate is held at these high levels, I would not be surprised over the next 2 months to hear someone from the Fed say, we may need to hike rates again. And that's really going to throw everyone through a loop because that's going to send US yields incredibly high. It'll probably send US yields back into the high 4% range, possibly above the 5% range again. And that'd make the US dollar insanely strong. I mean, this is, depending on how you look at this, yeah, this is really good for the United States dollar, but this is really not good for consumers. This is really not good for purchasing power. Uh, this is going to potentially lead to a further slowdown in consumption in a lot of places in the United States. So while hiring is picking itself back up, note that one of the reasons why also hiring is still increasing, I believe it was healthcare, right? Healthcare is very price inelastic. So whenever you need a surgery, you really don't care what price you're paying for it. So, you know, damn inflation. I need my heart surgery. You're going to pay whatever it is you have to pay for it. And in that case, a lot of healthcare providers are totally fine saying, hey, come and work at our hospital. We'll give you a 10% pay increase. So you're also seeing this upward move in wages, upward move in employment from people who were let go. And then also how many of those jobs in NFP are people taking on, more than 2 jobs again? This is getting really, really bad for kind of the overall health of the economy. So while this might look good for stock, oh, 1 second. As we'll see, I'm just going to go ahead and put this stuff back where it was. There we go. Bring that back up. While this could be really good for stocks, and you can actually see all these equity indices here on the right doing really, really well. This is the top 10 assets in the S&P 500 weighted. So this is a custom index I made through TradingView. And you can see we're just holding up. We had this really horrible day, and we've still been holding up prices here because the economy is technically growing. Don't get me wrong, but the quality of life is not improving. Yeah, the Russell did not improve terribly. The Dow kicked back. The NASDAQ also kicked back here. You can see the expectations have been off, off, off on the equity indices here. The Nikkei also saw a little bit of a bounce. It's been on a big old negative drift here. The Bank of Japan, as a little side, we're probably going to see above 152 at some point. I know we've been going sideways effectively for almost a month here on the dollar yen, but it doesn't seem like the Bank of Japan or the Ministry of Finance really is going to intervene until we're now actually above 152. So no one really wants to play this gambit with the government of Japan on intervention. It's but it's really not looking at this is probably going to end up still going higher. On the dollar front, yeah, we hit our expectations, and on all these dollar pairs, we did hit our expectations. So let's go ahead and start this thing off with our week ahead expectations. Let's look at our low odds here. So we have quite a lot of lows for next week seasonally right around this spot here. And if I recall, going back to the high data on Aussie dollar, we have a lot of our highs right around here. So we'll probably see our high around here and our low around here next week. And now it's just a matter of figuring out, well, in which order do we go? Do we go up and then down? And I'm starting to think that's probably going to be the move here. A little bit of up and then a little bit of down. These yield spreads, while somewhat positive, they're essentially flat. Short-term yield spreads are mostly negative. Yeah. I'll go ahead with that expectation of a bit of up and then lower into the week. Let me go ahead and timestamp these. Copy that so I don't have to keep typing in the timestamp. And now let's look at our closing odds here. And a lot of closes are up here. So maybe some sort of rebound into the close. Now, a different indicator, one that doesn't use seasonal data. Okay. Okay. Let's go ahead. I want to see if there's a little bit of overlap with these lows here. Yeah, roughly around here. So maybe a bit lower. Okay, that makes sense. Let's go ahead and look at our closing odds here real quick. Yeah, a lot of closes up here, but also some closes here. This is what I would call bimodal. So you have a peak here where you see a lot of your closes for any given week. And then you have a chunk of closes right here. So these are just the peaks where most of the time you find your closes around here. And in particularly bullish weeks, you get your closes in this sort of gray area right here, like we did this week. Yeah, man, I thought I was going to be really pinpoint on top of it when we were trading, like way down here on the close. But it zoomed up. I'd say this is kind of within margin of error, to be frank. So going into the next week, I think that's a fairly decent expectation. Some guys who are doing TA are saying stuff like that, like, hey, you're just looking at a support. The difference between what I'm doing and doing these sort of drawings is that I'm not looking back in history, looking at this historical data and trying to extrapolate, hey, there's resistance at these spots. Whenever there is a coincidence when TA lines up these statistics, it's just that. It's, what's it? What's the word for sometimes seeing patterns when they're not there? At least in this case, I have some stats, even if they're seasonal, to at least say, hey, generally next week, this is probably the nominal outcome. I could be wrong on whether or not we go down first and then up and then down into a close. So the order of these could be out of whack, but this is the whole point of setting expectations. You want to try your best every week, every month to figure out what's likely to happen next And then as you are wrong or as you are right, to kind of update your mental map of, oh, I was right on these expectations. I should do the kind of work that led me to make those good expectations again. And the same thing when you set bad expectations. You have to go and figure out, oh, why did these expectations not line up with what actually was realized? And I think that's a much healthier way of approaching markets. And in this way, you don't have to catch up on every single one of these streams to figure out what exactly I thought or when exactly I'm wrong or when I'm right. You can just look at these arrows and see, oh, he thought he would go up and down and there. And yeah, maybe he was a little off there, but this looks pretty on point. That doesn't look on point. That looks pretty good, but there was a huge overshoot for that week, right? So you can get into the nitty gritty of, okay, this worked here, this didn't work there. And you can build up your repertoire of knowledge, find out why you were wrong, why you were right, and kind of build up your competence in, I think, a more meaningful fashion with this sort of exercise. Let's move on to the next asset. Wow, this was really a really good expectation from last week. All right, let's go ahead and go through the whole rigmarole again. This is going to be pretty interesting because you have a lot of lows right here and here, and a good chunk right here. So this is going to be using the seasonal data kind of hard to pinpoint, in my opinion, where exactly the low is going to end up. But if we are going to be bullish in the first part of the week, wow, check that out. A lot of your highs are way up here. And by the way, if you're looking at these pivots and you're realizing they're probably a bit different from what you're typically used to seeing, that's because I'm using average true range pivots. If I use the traditional pivots, which is the default setting on a lot of my pivot point indicators, they look more like this. I use ATR pivots more so now because I find that the ranges are more consistent. The volatility of these ranges is, incorporating the true range of the prior period helps a lot in making these a bit more, I wouldn't say necessarily accurate. I just like the finer granularity because when you look at these traditional pivot point types, you see how wide this is. I mean, we're talking 30 pip ranges, and you can get very expanded or very compressed pivots from one week to the next, and that can lead to a lot of guessing. You could be off by 20 or 40 pips from where the thing actually tops or bottoms out. And recently I found better help with the ATR pivots personally. So looking at this, yeah, while I would like to set this expectation, a lot of the research that I've seen on future expectations for the New Zealand economy are not great, to be frank. Hold on. Do let's see here. Hey, we're getting a rate decision for New Zealand, I believe on Tuesday, right? Let's see here. It doesn't say Tuesday, but I did look it up in the calendar. So on Tuesday, we're going to be getting a central bank meeting here out of New Zealand. And the expectation is that they're going to essentially hold firm on their current rate path. Um, I'm not so sure they're going to be exceptionally dovish or hawkish. I think they're just going to keep up with the status quo. They might be on the more dovish side, to be frank, looking at the manufacturing improvements in a lot of countries and saying, hey, especially the manufacturing, the ISM manufacturing, or not ISM, the PMI manufacturing improvement out of China. If you didn't know, New Zealand sells a lot of their whole powdered milk, which is their biggest commodity there. They export a lot of that to China, and the price of whole milk powdered milk in New Zealand has been falling and falling and falling. In fact, I have the commodity price for it right here. We can hide this and turn it into a line drawing for easy use. Oh, it actually looks like it's improving. That's nice to see. But I was section over here in memory. This is why you have these things open. So yeah, looks like, yeah, just in the last few days here of April, especially, yeah, it's up 2% today. Wow. So that is a huge improvement. Again, the news out of China is leading to some improvements in commodities. I mean, outside of iron ore, I think. Yeah, iron ore is now officially below $100. This is a really bad story for Australia. This seems to be good for New Zealand, but their currency is quite weak. But the expectations are for this currency to continue its weakness. So I really wouldn't want to set too high of an expectation. Maybe up to here makes more sense to me. I'm not especially risk on for New Zealand at the moment. To be frank, I'm just really, really not risk on New Zealand. So let's go ahead. And by the way, we can these expectations. I just have to put in an updated timestamp, and these arrows never get deleted. So let's go ahead and look at the lows. Yeah, a lot of lows are like way down there. Set that to red. So this would probably be going into the central bank meeting where they say, hey, everything's pretty hunky dory, but we're going to keep things essentially the same. And the yield spreads are also not very, very positive here for the New Zealand dollar. Let's go ahead and timestamp that. So there's a few things working against the New Zealand dollar at the moment. I'm going to look at the low odds real quick. And wow, that actually lines up with a peak here. Yeah. So I'm taking the more conservative upside approach. Hello, kitty cat. Cat just walked into my room. 1 sec. I'm gonna put her back outside the room. Okay, I'm back. Take off my jacket. Okay, let's get back into this. So now what I want to do is I want to look at the closing odds. Probably a lot of closes around this area here. Wow, this is super choppy. Super, super, super choppy. Again, this is kind of representative of surprises from when the Reserve Bank of New Zealand has historically done economic surprises. So I'm going to go ahead and bring up the ranges. Yeah. I'd probably set my nominal expectation of a close like this down here or a bit higher like that. So I'll kind of split the difference. So that'll be my expectation going into next week. But as we go through the streams next week for the daily plans, I'll very likely add new expectations if we don't line up with this sort of view here. All right, let's go ahead and check out another currency here, pound. This thing really overshot the downside expectation here and then went all the way back up to the nominal and closed right here after plummeting super hard. What did the yield spreads look like here? They are super bad. Yeah, I am not sure this is going to be a great thing for the pound. All right, let's go ahead, look at the lows here. Wow, a lot of lows right here. Where the bottom of that wick was that we got earlier today. So if we go along with the plan that we've set for a lot of these assets, it should look something like this. Let's go ahead and look at our highs real quick. Set that to red, and yeah, we got a lot of our highs right around there. And that's also a peak on the ranges. So from the pattern that I'm seeing here, it looks like we'll end up having some movement going up into Tuesday, some bullish movement going up into Tuesday, and probably in the latter half of Tuesday going into Wednesday, the bearish move comes in. Now let's go ahead and look at our closes. Are these all over the place too? Less so. A little bit more rebound, sort of closing range bound potential here. Let's go ahead and look at our closing odds. Yeah, I'm going to go with the more nominal closing odds here. And we can bring up the seasonal data and you can see some closes that are down here. Again, when these yield spreads, unless these yield spreads start to improve here on the daily chart, these negative yield spreads are a leading indicator of FX prices. I mean, that's pretty nutty. Yeah, the volatility in the pound has been kind of nutty to set expectations for. So would not be surprised to see this thing. It's one of the more volatile FX pairs recently, so I wouldn't be surprised if these either get overshot or undershot. And now on to the euro. I did take a shot on this going, I think this is after, yeah, right here is the manufacturing PMIs that came out, and right here is the non-farm payrolls. So I took this shot here, and now I'm looking at this and I'm like, yeah, this is pretty much gonna look something along the lines of this net on the week. But first, we're gonna look at our high odds. Yeah, a lot of highs in this area right here. Close to 50% of highs next week are roughly around this area here. So wouldn't be surprised to see it even move a little bit higher, right, into this spot around. But it's, that probably could even be an overshoot. But for now, let's set this up as our nominal expectation to the upside. And on the low end, wow, these odds are pretty small and fairly spread out. There's a good chunk of lows right around there. So maybe something along these lines here. Set that to red as the bearish timestamp that. And now let's move on to our closing odds. Yeah, it becomes a guess where the close ends up. And I say that because either looking at these odds nominally, seasonally, most of the closes come in around this area here I just circled. But when you move down this far, you put yourself at risk at closing pretty much in anywhere around this area here. Notice how all the odds are really small and very similar. This is a fairly uniform look, and that's a fairly random outcome. So anywhere in this area, once you're down here, is kind of fair game. So I don't know if I want to set a end of week expectation for this, because the end of week expectation I think could just be, wildly off. I mean, if I go with what we've been doing for the rest of these assets, probably something like that. But then you can even see here on the ranges with the non-seasonal data, a lot of closes around this area. So maybe just more sideways movement, essentially closing the week under 108. Okay. Let's go ahead and check out the dollar CAD. The yield spreads are moving a lot more positive recently, and these closes are pretty net bullish. So it's not looking good. Also, Canadian unemployment, I think, hit Canadian unemployment hit a 2-year high. This is the highest unemployment since October 2021. So this is really not good for Canada. And a lot of closes are up here too. So you got some closes down here, but these yield spreads definitely do not support the view of closing way down here. If I recall, we also have a meeting next week, so we also have the Central Bank of Canada coming out. And based on the unemployment data that came out, more people are expecting the Bank of Canada now cut in June, which is pulling them closer. I think they were expected to cut in like July or September. So their rate cut is getting pulled closer to today. And when you're talking about central bank rate differentials, the United States is probably going to have a higher rate. Bank of Canada is going to have a lower rate. And also the yields of the bonds in those two countries. The United States is going to have higher yields on the bonds, so more people are going to want to have US dollars. Canada does have one thing going for it, and that's the rise in oil prices, but a lot of the oil refining and energy production in Canada is getting insanely taxed from the Trudeau government. So it's really, really hitting companies and consumers hard to pay those carbon taxes. So a lot of highs up here. Let's go ahead and look at a low first because this is dollar CAD. So it's kind of a guess, in my opinion, as to where the low usually comes in. We can go ahead and set this as our nominal expectation. And then from here up, go ahead, look at our high odds again to around here. Yep, that looks good. And then there's some risk of going really high up to the high 36s. I really, really would not be surprised to actually see this move. So I'll actually put that in here. And one of the reasons why I'm actually setting this expectation, by the way, is because of these monthly ranges. So I just changed the chart time frame to a daily, and the indicator automatically changes the range, the higher time frame range that it's looking at. And so now this is giving me where the highs usually come in for a month. And maybe next week we end up hitting monthly targets here. So I'm going to set this more bullish expectation, even though it's not the more seasonal thing to do. Essentially, it's an overshoot here. Let's look at the closing odds real quick. Yeah, maybe a bit of a pullback from here to here. And something to think about, when you have closes up here, it implies you need a high above that, or you need your high at this same level. So when I'm setting an expectation for a close, generally speaking, I want to have my expectation for the high to be somewhere above or very close to where I'm setting my expectation for the close. And vice versa if this is a more bearish expectation. So let's go ahead, set this to blue for a closing expectation, and go with that. And on the yen, oh wow, that's a pretty split setup. I mean, you can clearly see you have either your closes up here or your closes here over the last 21 years. This is definitely a bimodal shape to the histogram here. It seems like your odds are pretty evenly split above and below the central pivot. I would put the positive drift on this. So I'm not going to set high and low expectations on this, but I am going to set net bullish closing expectations going into the week ahead. All right, now we're into the commodities space. And the commodities space either is going to probably rip your face off again next week or have more nominal pullback next week. So let's go ahead, look at our odds. And yeah, finding the low is almost like a guess. So there's kind of two setups here depending on your expectation. Either the low comes in around here next week, so you get a slight pullback, and TA guys are probably looking at this, right, from this spot around here and expecting the thing to hold up. And there's good odds of that. But also there's good odds of falling back a bit more to this 85 handle. And instead of drawing your line from here, you'd be drawing your line from around these lows. Essentially, it's pick your poison around these lows. I'm not so sure if this is going to be the more likely scenario. I'm still fairly bullish on oil. Reaching $90 does seem like the more likely scenario, in my opinion, sometime this month. And yeah, pretty good odds of actually a bearish continuation here for next week. So these are not good odds really for oil. I think I'm going to have to hold off on setting expectations here on oil because this is my personal expectation is to still stay bullish, but these ranges and these odds here are frankly saying otherwise. So I'm going to instead look at the closing odds and set a closing expectation here. Yeah, you can see a lot of your closes here and a good chunk right around there. Let's go ahead and set a nominal closing expectation to around here. Again, don't try and think too hard when setting expectations, at least with the method that I'm using, right? I'm just finding where the most likely close is going to be. With the information that I'm taking into account, what do I think is likely? And as we trade through the week, as new information comes through, I can update my expectations. Nat gas, oh, this thing followed expectations pretty much to a T, up and then down. And we rotated right when we wanted to see the rotation. And next week is just straight up bullish on net gas. Uh, yeah, that is just straight up bullish. I'm just going to set a positive drift on this thing to this high, or rather to it's a 7 cent move on nat gas with some risk of going particularly high. But again, the nominal expectation is along these lines here. And if you have an expectation exceed your, let's say you have a bullish expectation like I'm setting here, and you end up going higher on a bullish expectation, then your expectation got beat and you were still positioned in the correct move directionally. That might not necessarily work for every single trader, like guys who are trading options and are saying, well, I think we're not going to go past this R2 pivot at 1.924. So I'm going to sell some calls around here and sell some puts around here. I think we're going to mostly trade in this area. That can be quite dangerous in an environment like this, in my opinion, just because of how bullish the commodities and energy space is right now and how much that's contributing to inflation and how willing, as we've seen from the manufacturing PMIs, manufacturers are to pass on their higher costs to their consumers now. I mean, that's the entire reason why a lot of these manufacturing PMIs are jumping. As far as gasoline goes, this is more of a sideways week with upside risk. As you can see, a lot of your closes around this area right here. So nominally, this thing is flat, but there is good risk of doing something like this. And I based on this trend, based on this momentum, if you just extrapolate this over the last week and potentially over the last call it couple of months, this is not the weakest expectation to set. Yeah. I'll go ahead and actually set that as my expectation going into next week here. Okay. Okay. Gold. We love it. And it's now at 2350. I didn't even see this until I pulled up this chart. This thing is, I think, probably going to find some local high next week and then pull back. Check that out. Right on the money. That's just, that's just why I got a good gut feeling. Yep. Reach a new high, pull back into a close. So probably we'll end the week green, but I think we're going to have some more sidewaysy action here on gold in the meantime, just for this next week. At least based on those odds. This is copper. Copper is kind of all over the place here, it seems. These are very uniform looking odds. I mean, this tells me I should be setting expectations for going sideways, but as Chinese manufacturing comes online more, they need more copper. And I really wouldn't be surprised to see copper just go on a tear and just rip your face off this month. Yeah, you're already here at a very extreme level on a closing basis. And there's a chunk of highs up here on the month to be concerned about for copper. And if you're not seeing what I'm seeing here, what I'm looking at here in this distribution is this little bump right here. So you see how there's a trough of data. The odds decrease here on the right-hand side. So this is a histogram representation, a visual representation of the data here on the right. So a lot of highs do come up here during particularly bullish months. So I'm going to go ahead and lock that in, that bullish continuation here. And let's see here. Anything else? Oh, we got the good old Bitcoin. And Bitcoin's just holding up. Speaking of, let's go ahead and check out the halving. We are 14 days, 14 hours, 59 minutes, and 53 seconds to the next Bitcoin halving. Again, this is an estimate. And the difficulty adjustment just keeps increasing here. The last difficulty adjustment was like 1.0508%. The difficulty of mining a block is going higher and higher and higher. This is going to generally increase the cost of mining Bitcoin. And as you go into the halving, that's going to be a huge jump in difficulty. Well, actually, it's not going to be a huge jump in difficulty. It's going to be a huge cut in the reward. That's the correct way to put that. But as the difficulty goes up into the halving, and you see the cut in that Bitcoin block reward, some miners are going to have to be taking out loans to stay in business till other people go out of business, so then the difficulty actually collapses. Because when the amount of Bitcoin you were mining cuts in half, you have to adjust that in your operational costs. And that either has to come from the price of Bitcoin going higher to account for the smaller amounts of Bitcoin that you're mining on every block, or the difficulty going down, so then you're more economically efficient at mining the smaller amounts of Bitcoin. Usually during these times, a lot of Bitcoin miners take out a lot of debt in order to kind of stay afloat while the difficulty readjusts and some players, stop mining, go out of business, or until Bitcoin's price rises. So once the halving comes in, it essentially becomes a waiting game. And let's actually measure out 14 days here. So that's actually April 20th. That'd be hilarious if Bitcoin had its halving on 420. There's kind of a crossroads in both of those crowds, huh? So I think this is a pretty good week ahead stream. Anyone who's in the trading group or has access to these indicators, or even the trial to these indicators, link to that's in the description. You can go ahead and join me tomorrow for the outlooks review, where we'll be kind of going more in depth on some of these expectations and some more depth economically onto what's to be expected with especially some of these central bank meetings next week. And maybe over the weekend, I'll be updating some of these expectations here. And then I'll update you guys on the Monday stream when I'm back. So I hope you all have a good weekend. And I'll see you guys in a bit.